Welcome to Fast Forward on Finances, where Greg and I bring you timely and useful information on financial matters that affect your life.
In this segment, we're looking at the topic of refinancing.
Greg, why don't you explain what refinancing means?
Refinancing is another way of saying taking out a new mortgage on property.
And why would you want to do that?
Well, typically, homeowners refinance to take advantage of a lower interest rate.
So if your current mortgage rate is, say, 7.9%, and you could get a rate of 6.5%, it would be a good idea to refinance?
Generally speaking, yes, because you'd be lowering your interest rate by 1.4%. But there are other things you should consider too, which we'll talk about in just a minute.
What are other good reasons to refinance?
You can transform the equity in your house.
When you're deciding to refinance, if you're considering it, the first question to ask is, why am I doing this? Am I trying to take out more money for a home remodel to pay off some credit card debt? There's some serious consequences to doing something like that. Or am I taking this out to get some more security in the mortgage? Perhaps I'm in a high rate of interest, a mortgage with a high rate of interest. Maybe there is an adjustable rate. Maybe I've got a balloon payment on my mortgage and I'm being forced to refinance. There's a lot of different strategies with it.
Refinancing definitely has its pros and cons, and you want to make sure you do your research before you refinance. Look for loans that have great interest rates, and also know yourself. If you refinance and take some of the cash out, for example, to pay off credit card debts, the great thing is that you may have lower interest rates and perhaps your payments can be tax deductible. The downside, however, is that you're turning unsecured debt into secured debt, meaning that before you just had credit card debts, but now those debts are connected to your house.
So if interest rates go down, I guess it's a good idea to refinance.
Not necessarily. It depends on what your payments are now and how much equity you've got in the house. You'll have to pay closing costs when you refinance, so you need to consider whether you'll live in the house long enough to recoup those costs.
I imagine the type of mortgage you've got and the type you're getting will make a difference too.
Absolutely. The financial experts we talked to had this to say.
A fixed rate of interest means that the interest you'll be charged stays the same. Your payment generally will stay the same every month. An adjustable rate mortgage, or an ARM, means that the interest rate will float with a certain index, certain financial index, and it may go up, it may go down. There are caps for how many points of interest it can go up in a certain period of time, and there's a maximum cap as well. Not all adjustable rate mortgages are bad.
Okay, so you need to consider interest rates and closing costs. Are there any other things you should think about before determining whether to refinance?
We've got some insights from our financial experts.
You probably want to look for a financial institution that's got some history, that you know that it's a solid, trustworthy institution, that they will give you good rates. I mean, good rates will also depend on your credit score, but definitely look out for more than one lender, preferably in a short period of time, so that that does not affect your credit score.
APR is the annual percentage rate, and it's basically the amount of money that you're being charged on the annual amount. If the APR is 20%, you're paying 20% on every dollar. If you have an adjustable rate mortgage, that's not necessarily a bad loan, but you need to be more aware of what your obligations are, how high the mortgage can rise, how frequently it can go up and down, and adjustable rate mortgages do go down as well. It fluctuates, again, with an index. An adjustable rate is going to appeal to somebody with a little higher tolerance for risk and someone who has the money to cover should the payment go up.
So you kind of have to sit down and weigh the pros and the cons of everything that you have in front of you and determine how is this going to better our lives moving forward.
Really interesting stuff, Greg. But unfortunately, our time is up for this segment of Fast Forward on Finances. We'll see you next time.